Hey you want to make some serious dough in the market? Well, buckle up because we're about to take a wild ride through the ins and outs of finding those hidden stock gems. We're talking about the kind of stocks that make you jump out of your seat yelling, buy, buy, buy at the top of your lungs. This ain't for the faint of heart, folks. We're going to break down the walls of Wall Street and give you the tools you need to become a stock-picking machine. Forget those fancy analysts with their charts and graphs. This is about understanding the game, understanding the players, and understanding how to spot a winner a mile away. Are you ready to make some money? Let's do this. Listen up, because this is where the rubber meets the road. This is where your dedication and focus will truly pay off. Finding great stock ideas isn't about sitting in some ivory tower crunching numbers. It's about immersing yourself in the world around you. It's about getting out there in the real world and keeping your eyes peeled. Observing, analyzing, and understanding the dynamics at play. You got to be like a detective, always on the lookout for clues. Every detail matters. Every piece of information could be the key. What kind of clues am I talking about? Well, let me tell you, these clues are everywhere if you know where to look. It's about noticing the little things. What are people buying? What products are flying off the shelves? What are they talking about? What topics are dominating conversations? What are the hot new trends? What innovations are capturing the public's imagination? These are the seeds of stock ideas, my friends. Think about it. Every major company started small, with just an idea. Before Starbucks was on every corner, it was just a little shop in Seattle. It took vision to see its potential. Before Apple was a tech giant, it was just a couple of guys tinkering in a garage. They saw a future others couldn't. The signs were all there, you just had to know where to look. It's about connecting the dots before anyone else does. It's about having that sixth sense, that nose for opportunity. It's about intuition and insight. It's about seeing the potential in something before everyone else does. It's about foresight and vision. The best investors are also the best listeners. They absorb information from all around them. They pay attention to what's going on around them, and they're not afraid to follow their gut. They trust their instincts, so go out there and make me proud. Use your skills, your knowledge, and your intuition. Find those hidden gems, those diamonds in the rough. They're out there waiting to be discovered by someone with the vision to see them. Now, I know what you're thinking, Jim. I'm not a financial whiz. I don't have a degree from Wharton. Well, let me tell you something. That doesn't matter one bit. You know why? Because you've got something even better: experience. You see, everyone has their own unique set of skills and knowledge. Maybe you're a doctor, a lawyer, a teacher, or a plumber. Whatever it is, you know your stuff. And that, my friend, is invaluable. Think about it. If you're a doctor, you probably have a pretty good understanding of the healthcare industry. You know what drugs are in demand, what medical devices are hot, and what the future of healthcare looks like. That's insider information. The same goes for any profession. If you're a software developer, you're plugged into the tech world. If you're a teacher, you see firsthand what kids are interested in. These are all valuable insights that can give you an edge in the market, so don't be afraid to play to your strengths. Invest in what you know. All right, now it's time to talk about the big picture. The macro environment. This is where we separate the amateurs from the pros, because understanding the macro forces at play is crucial to making smart investment decisions. What do I mean by macro? I'm talking about the big stuff: interest rates, inflation, economic growth, government policies. These are the tides that move the market, and you've got to know how to ride them. First up, interest rates. These are like the gas pedal of the economy. When rates are low, borrowing is cheap, businesses invest, and the economy grows. When rates are high, the opposite happens. So you've got to keep your eye on the Fed and what they're doing with rates, next inflation. This is the silent killer of returns. When prices rise, your money buys less. So you've got to make sure your investments are keeping pace with inflation, or you're losing ground. By understanding the macro environment, you'll be able to make more informed investment decisions and ride the waves of the market to success. Now that we've got the macro stuff down, let's zoom in a bit and talk about sectors. You see, different sectors of the market perform differently depending on the economic environment. It's like the stock market is a giant mall, and each sector is a different store. Some stores are always busy, some are seasonal, and some are just plain dead. So how do you know which sectors are hot and which are not? Well, It goes back to what we talked about earlier. Paying attention, you've got to be aware of the trends, the news, and the overall economic climate. For example, when interest rates are low, sectors like real estate and utilities tend to do well. Why? Because they're heavily reliant on debt financing. On the other hand, when interest rates are high, these sectors can take a hit. The key is to be able to connect the dots. Once you have a good understanding of the sector landscape, you can start to identify the areas that are poised for growth. Chapter 5, Screen like a pro. Alright, now it's time to get down to brass tacks and talk about stock screening. This is a crucial skill for any serious investor. This is where we separate the wheat from the chaff, the contenders from the pretenders. It's all about finding the right stocks that have the potential to grow, because if you want to find those hidden gems, those stocks that are going to make you a fortune, you got to know how to screen. It's not just about luck, it's about strategy and knowledge. Now, there are all sorts of fancy stock screeners out there, but let me tell you something. You don't need anything complicated. Simplicity can often be your best friend in this game. In fact, you can do it all with just a few key metrics. These metrics are the backbone of any good stock screening process. First up, return on equity, or ROE. This is a fundamental metric that gives you insight into a company's profitability. This tells you how efficiently a company is using its shareholders' money to generate profits. It's a clear indicator of management effectiveness. The higher the ROE, the better. A high ROE means the company is doing a great job at generating returns. I like to see an ROE of at least 15%. Next, net profit margin. This is another critical metric. This tells you how much profit a company is making for every dollar of revenue. It's a measure of efficiency and profitability. Again, the higher the better. A high net profit margin indicates that the company is managing its costs well and is able to convert more revenue into actual profit. I'm looking for a net profit margin of at least 20%. This shows that the company is not just making money, but making it efficiently. Then there's operating profit growth. This metric shows how well the company is growing its core business operations. I want to see strong, consistent growth here, at least 25% or more. Consistent growth is a sign of a healthy, expanding company. By focusing on these key metrics, you can screen stocks like a pro and make informed investment decisions. Happy screening! Chapter 6, The Moat. Now let's talk about something near and dear to my heart, the moat. This concept is not just fascinating, but also crucial for anyone looking to understand the dynamics of successful investing. This is a term coined by the Oracle of Omaha himself, Warren Buffett, and it's one of the most important concepts in investing. Buffett uses this metaphor to describe the competitive advantages that protect a company from its rivals. So, what is a moat? Why is it so significant in the world of business and investing? Simply put, it's a company's competitive advantage. It's the unique edge that allows a company to fend off competitors and maintain profitability. It's what sets it apart from the competition and allows it to generate sustainable profits over the long term. This is crucial for long-term investors who are looking for stability and growth. Think of it like this: a castle with a wide, deep moat is very difficult to attack. The moat serves as a formidable barrier against invaders. The same goes for a company with a strong moat. It acts as a protective barrier, safeguarding the company from competitive threats. It's protected from competition, which means it can charge higher prices, earn higher margins, and generate more profits for its shareholders. This financial strength is what makes a company with a strong moat so attractive to investors. So, what makes for a strong moat? What are the key elements that investors should look for when evaluating a company's competitive advantage? Well, there are a few things to look for. Several factors can contribute to a company's moat, making it robust and durable. Brand recognition. A strong brand name can be a powerful moat. It creates customer loyalty and can often justify premium pricing. Think about companies like Coca-Cola, Nike, and Apple. These brands have built a strong emotional connection with consumers over the years. Their brands are so well known and respected that consumers are willing to pay a premium for their products. This brand loyalty translates into consistent sales and profitability. Economies of scale. This is when a company can produce goods or services at a lower cost than its competitors due to its size and efficiency. This cost advantage can be a significant moat. Think about companies like Walmart and Amazon. Their massive scale allows them to operate more efficiently than smaller competitors. They're so big that they can negotiate lower prices from suppliers and pass those savings on to consumers. This not only attracts more customers, but also makes it difficult for smaller competitors to match their prices. Chapter 7. Don't put all your eggs in one basket. All right, we've covered a lot of ground today. We've talked about finding stock ideas, understanding the macro environment, screening for stocks, and identifying moats. But there's one more crucial piece of the puzzle: diversification. Now, I know you're probably thinking, Jim, you've been telling me to find those big winners, those stocks that are going to make me a fortune. Why are you telling me to diversify now? Well, here's the thing. Even the best investors in the world make mistakes. Nobody bats 1,000. And if you put all your eggs in one basket, one bad investment can wipe you out. That's why diversification is so important. By spreading your money across different stocks, sectors, and asset classes, you're reducing your risk. That way, if one investment goes south, it won't sink your entire portfolio. Outro. Now go make some money. Listen, we've gone over the playbook, we've studied the tape, and now it's time to get in the game. Remember, finding those monster stocks, those 10-baggers, it's not about luck, it's about discipline, it's about research, and it's about having the guts to pull the trigger when you see an opportunity. Don't be intimidated by the Wall Street bigwigs, those guys in their fancy suits with their fancy degrees. You've got something they don't have. Street smarts. You've got the hunger, you've got the drive, and now you've got the knowledge. Now go make some money.